annual meetings of the World Bank and the International Monetary Fund in Washington, D.C. will no doubt grab a lot of the headlines in the coming week, not least as they both stretch from the 10th to the 16th of October. Some investors will find the IMF's latest biannual World Economic Outlook document extremely useful for its data and its thematic studies. Others will find the macroeconomics interesting, but wonder what use the forecast can have from an investment perspective. Others still may just dismiss the whole week as the work of prolix windbags who've never successfully called a recession in their life. Only you can know which camp you're in. Now, closer to home and perhaps a bit more tangibly, the Office for National Statistics is scheduled to release the latest monthly unemployment and wage growth figures for the UK on Tuesday, the 11th of October. These will cover the 3 months to August. The stronger the jobs market stays, and the faster wage growth gets, or at least the more entrenched wage increases become, the more the Bank of England may be inclined to take interest rates higher than expected, faster than expected, and then keep them there for longer than expected. That said, markets are already pricing in a base rate of 5.5% by next March, way above the 2.25% level set by Governor Andrew Bailey and his colleagues at the September meeting. In terms of the jobs numbers, the headline figures to watch are as follows. The unemployment rate was 3.6% last time around, below where it was before the pandemic and near all-time lows for a data set that dates back to 1971. The average weekly wage, including bonuses, reached £613, up 5.5% year on year, which looks nice, but it is nevertheless still well below the prevailing rate of inflation. And job vacancies, now they were 1.27 million. The good news on the face of it is that figure just exceeded the number of unemployed of 1.22 million. The less good was that vacancies fell for the second month in a row. Some may jump on this as the first sign that the UK economy is heading into a wider slowdown. Others will say the big vacancies number will act as a buffer and help the government and Bank of England engineer a soft landing as the vacancies disappear before firms must start thinking about the terrible prospect of redundancies. From a bottom-up perspective, there's a fair slate of corporate announcements that are scheduled for the coming week ahead, including trading updates from a trio of FTSE 100 firms. Companies which may be worthy of further research include the following, although do note that some of these dates could yet be subject to change. So after a quiet start to the week, Sanderson Design, Marston's and Reach on Tuesday the 11th, Barratt Developments, Kinetic and Marks & Spencer's on the 12th, N10 and EasyJet on the 13th, and Mondi, Jupiter Fund Management and Ashmore on Friday the 14th. But the company which could just cause the biggest fuss in the week ahead is Robert Walters. The FTSE All-Share Index members due to release a third quarter update on Tuesday the 11th. Now, Robert Walters is a recruitment specialist, so this takes us back to the issue of jobs. In theory, jobs are one of the best indicators of the health of an economy, albeit one where the data comes with an inbuilt lag. This is because companies take time to feel profitable enough and confident enough to build up to and then get on with hiring people, let alone go through the sometimes tiring and vexing process of interviewing and choosing the right candidate and then offering them the terms that will persuade them to sign on the dotted line. This caveat aside, the update should be informative, not least because Robert Walters reported its best second quarter and first half ever in 2022. The firm also upgraded profit forecasts alongside July's second quarter update and announced a 20% dividend hike and a share buyback alongside its first half results. So on the face of it, things are pretty buoyant. Eponymous Chief Executive Robert Walters flagged an acute shortage of suitable candidates, strong demand, high job churn, and increasing wages as factors behind the bumper numbers. Analysts and shelves will be looking for any change in that upbeat picture, especially as the share price just doesn't seem to care. It stands at its lowest level since late 2020 after a fall of more than a third in the past year. Remember that in the second quarter, fee income grew 26% year on year, the fifth straight quarter of 20% plus growth, and it's fee income that will be the main headline figure from this update. Within that, of the major regions, Europe showed the fastest growth, followed by Asia Pacific, with the UK lagging a little bit. Note that the UK represents about a fifth of the total business now. One other useful indicator to watch is headcount. If Robert Walters itself thinks there's business to be won and done, then it will hire more staff to do it. And in the first half, Robert Walters' own headcount rose 16% to 4,051. And should management give any reference to earnings for the full year, the current analyst consensus is looking for pre-tax income of £56 million against £50 million in 2021. Also note that fellow recruitment agencies, specialists, I should say, Page Group and Hayes, are due to release their own third quarter updates on Wednesday the 12th and Thursday the 13th. They've also been publishing positive reports this year, but have also seen their share prices retreat to levels last seen in 2020 all the same. I hope that you and your families are in good health and good spirits. Thank you for watching, and I look forward to seeing you again next time.